Welcome back. Second half of day 2. Really excited to see everybody back here. Going to listen to a fantastic keynote, I believe. I've known Joe for a while now. We've done a few site visits together, and his insights are second to none. I'm a subscriber to his newsletter. I highly recommend everybody taking a closer look. Lots of content on his website as well. And I'm just happy that he's here. He just came from a site visit. He's on his way back to Vancouver, stopping by. Thanks for gracing us with your presence, Joe. And really looking forward to your speech and presentation. Yeah, as Tarek said, you have an extra few minutes, and use them.
All right.
Fantastic. Thank you so much.
Okay, thank you. Right. So I hope I keep you guys focused for the next little bit. This talk is about copper, and most of my portfolio right now has been precious metals, but over the last year or two I've been transitioning, and one metal I've been looking to gain more exposure to has been copper. And so I'll explain the reasons that I think it's a long-term play and why I'm moving in that direction. Okay, so I will go through certain copper market highlights right now, what we're seeing, and then its role as a critical mineral, which is important with respect to the growth of the metal. But for me, like demand growth can change. There are risks there. But for me, the visibility on the supply side is more dramatic and more easily quantified. And then the constraints on future production, so near to midterm versus future. And so all the way down that, there are significant risks in terms of supply. And then, like what we like to see in any kind of cycle is M&A to lead us into a breakout. And, we've just seen a couple of transactions that have been happening with major diversifieds that are looking for more copper exposure, like your Rio Tintos and your BHPs. Okay, so first is the copper market highlights, and so this is a graphic of on the left, on the copper price and what it's done in 2022, and so you can see that peak earlier this year of $5 per pound, and then you could see the significant drop off, and there's reasons for the drop off with respect to the COVID zero policy of China. Having impact on demand, but also you could see that underlying theme of a stronger U.S. dollar coming up. So the copper price is down in U.S. dollars by about 17% when I did this graphic a couple of days ago, but the U.S. dollar is up 11. Okay, so a lot of that can just be explained by the U.S. dollar. And then if you look at some major consuming countries, it's actually up. Some places significantly up, almost 20% in Japan, 12 to 13 in China, and that's all currency, you could say weakness in the local or strength in the US. So when you're looking at this, and this applies to almost all commodities, including precious metals, that we see this dichotomy. And so if we look at it just like right now, what's happening with respect to production and costs, the costs are higher, and there's more production right now. So we have more potential concentrate than the smelters need right now. So near term, that's why you have a bit of a depressed copper price. The high labor costs are just like the entire industry in terms of whether it's mining, copper, gold, or going to your local restaurant and trying to get a table. The lack of labor, that's huge. And that impacts productivity. And then COVID might be over with some countries, but it's not over in places like Peru and Chile and some other places. And the other thing is fuel costs. So fuel costs, even though we may be seeing a moderation in the WTI, the problem is that all this stuff's got to be refined. And then you have to deal with the crack spread. And the crack spread is like how you deal with the distillates. And then what they need is diesel. And diesel got up to $200 a barrel in the U.S. like several weeks ago because they're just not making enough of it. And that's going to be impacting the producers as well. So in terms of production, two largest copper producers, Chile and Peru. Chile down significantly in terms of its production year to date. year on year. Peru up. And the other biggest one that changed Africa was the initiation of production at Kamoa-Kakula. But overall, production is actually up. So two negatives, let's say, in terms of production. Probably a positive in terms of the higher cash cost that drives marginal cost that requires a higher copper price. But now we've still got more production than it looks like the smelters need. So in terms of a specific company that I know and I visited and I have as a top pick was Ero Copper. And that's all Brazil based. And interestingly enough, they don't have huge power costs. They're all hydro and they're sort of contracted out to about 3.5 cents per kilowatt hour, which is very cheap. A lot of places that do hydro, they're almost 8 to 9 cents. So that's very good, but they're still getting hit by materials, consumables, contractors, labor, and maintenance. The range there is anywhere to 45 to 60% year to date, year on year. And that's like, we haven't seen the full impact of the fourth quarter yet with the oil prices moderating, which is a good thing. But then again, they need diesel. And so they're not exposed to the power issues, but they are exposed to labor and they're exposed to the issue about refining and getting diesel. And then if we look at, how this translates into economics, like we can see that if you look on the right-hand side, you see the last two quarters, the quarter ending June 2022 and the quarter ending September 2022. So March, we had a significant jump to June 22 in terms of the cost. So that's when it really hit in Q2. It was getting up since, let's say, December 2020. It was slowly rising, and then boom, it hit in June 2022. In September 22, that quarter, the cost stayed flat. And so that was part of the optimism in June to say, hey, like when they announced their quarter in September that, hey, it looks like costs are moderating, but they're still high. But then what hit them was a 90-cent drop in the average copper price. So they can't get that, 45% margin anymore. Now the margin shrunk to about 22. So that's what hitting companies right now. And Ero Copper is not alone, and that's a very well-run company with a lot of good local management. And so here's the other thing that you got to think about. If we do need all this copper, this is a cash cost applicable to sales graphic, where you could see some companies, some well-known mines like the Andina division of Codelco, where that's sitting at about $1.50. A project in Zambia sitting at about $1.60. But if you want to clear the entire market and take the entire production, you need $3.50 copper. And so if you look back, that's where we're bouncing around that, to get that production in, because those guys might not keep producing. And granted, it's not automatic. It takes a while to stop production because there is a cost to that. But that's around where we're sitting. So copper, unlike gold and precious metals, is a marginal cost industry. Price equals marginal cost in the long run. And so you got to watch this. And so the other issue is that, like, I worked as a copper market analyst for Phelps Dodge, and so I got to really understand the copper market as it was going from 55 cents to $2. And so one thing is the copper premium. The copper premium is what people are willing to pay above or below the LME price to say there's a lot of copper cathode out here or there's hardly any. And so there was a discount to the LME back in March of about $50 per ton. So here's the LME price, but I'm not giving you that because there's so much copper out here. But now it's broken out into about almost $150 per ton. And why? Because people are holding on to their inventories because they're not sure where they're going to get the next copper cathode. So that's a conundrum because what's happening, even though we have a lot of, like, mines produce, there's not a lot of SXEW, meaning, the oxide, which converts cathode right away. What they do have ample supply is sulfide, which converts to concentrate, but that needs a smelter. The smelters have issues because there's no power. There's drought conditions in China, making hydro hard to get, so they can't produce cathode. So the TCRCs for the concentrate, they'll go up, because they don't need your concentrate, because they have too much, because the smelter capacity is going down. But if I'm on the other side and I want that cathode, there is no cathode. So that's why the premiums go up. So now if we look at the potential demand growth here as a critical mineral. So the background on critical minerals, I did a piece on critical minerals, and there's one available on my website right now. The whole idea is Paris Climate Agreement, getting it to below 2 degrees. That's not going to happen. But then they say, okay, what are the minerals critical to do this? So there's a whole bunch of critical minerals that, in terms of a Venn diagram, but then there's the ones that are critical to what they call energy. So copper might be a critical mineral, but it might be also a critical energy mineral, as we'll point out, because of the infrastructure required for this electrification. But then the other problem is now with the Russian invasion of Ukraine is now these critical minerals, there's got to be a layer of strategic influence about where you're actually getting these critical minerals from. And that's layering another bit of an issue with the whole idea of who do you invest in, where do you get your copper from. So this is obviously the periodic table. And so the issue right now is a whole bunch of regions, the EU, Australia, Canada, and the US all put out critical mineral policies. Most of them are different. So the US has 50 elements and commodities in their critical minerals list that was done by their local USGS, but interestingly, copper wasn't included. So everybody looks at it locally in terms of what they need. The EV penetration in the States is not thought to be as strong as in Europe or as in China. So they may think that they don't need as much copper, and also they produce a lot of copper. So they might not think that, but it is, whether they want to believe it or not. Australia also doesn't have copper listed, but Australia is thinking about themselves, but where's that copper going to go? They're not going to consume them. They don't have a big manufacturing industry. They're going to sell it, and they're going to sell it to either India if China's knocked out, or back to the US. So, but the Europeans and the Canadians are a bit more aligned in that they've declared both about 22 minerals, and both of them have included copper. But interestingly, the Europeans are thinking more about scrap than they're thinking about production. You got to make something before you scrap it, as far as I'm aware. So copper, the big thing here is intensity of use. So there's a lot of traditional sources of copper, but these new products that they're producing, and old products, now require more copper. Your hybrid electric vehicles, your EVs, 2.5 to 4 times the amount of copper as a typical internal combustion engine, or an ICG, according to the Copper Development Association. 25 kilograms of copper needed for a DC charger. 4.6 tons of copper per megawatt for solar power. So it goes on, but you get the idea. The intensity ratchets up for these products. And then, so what does that turn out? So here's Vale. This is obviously biased because, they produce copper, but they're forecasting a demand growth of about 2.4% to 2030. But basically, it's even less than that to 2025. The big jump is when they think EV penetration will really take a hold after 2025. And that's when you get the big jump into 2030, which is about 12% from 2025 to 2030. And most of that's being generated by the electric vehicles and carbon neutral renewable technologies. So if you look at the supply-demand balance, that's really when it's going to hit. It'll start small, but it's going to grow. And the reason it's going to grow as much for the penetration is there's just not enough supply. And this deficit is going to be a bigger part of the entire global copper market. So this is the premise of why I'm bullish on copper, because the price has to go up to incentivize companies to deliver into this market. But even if they wanted to, I'm saying they can't. So if you really want exposure to the copper market, you want to pick up production around this time, because those are the guys that will go up quickly. Okay, so when here's the risk. And I would say the risk is not on the supply exceeding expectation in terms of production. I'd say there's less risk of that. More risk that there's just not enough critical minerals for the EV penetration to be as forecast, which I think is probably more of a legitimate risk. So what we're saying is going to happen isn't going to happen. It's going to be more moderate, but still on the copper side, you won't even have enough for that. So now we're going on supply chain risk just to the near to medium term production. So Chile and Peru are the biggest producers of copper. Peru is actually the biggest exporter of copper to China. When I was doing a talk there at the Peruvian version of PDAC several years ago. So BHP would love to invest in copper. They want more exposure, and hence the reason they, tried and close in the transaction with Oz Minerals. But they're not going to do anything until the current left-leaning president provides some more visibility into the fiscal stability agreements and what they actually have to dole out. And they're changing the taxes, they're changing the royalties, and now people have to rerun the numbers and make sure they're solid before they make the investments. But again, adding more taxes and royalties when what I showed you, which is not atypical for copper, the margins are shrinking, does not incentivize people to not only develop greenfield projects, but expansions. So the other problem is that, Chile has been its 13th year of consecutive drought. And we know about drought all the way in the States, Southwest states, and that water's huge. And that's been the thing in Chile forever. Like when I worked there in the 90s, it was like if you drill a hole for copper, the next hole's got to be for water. But now that has ratcheted up to the extreme. And so now the State Defense Council, and this is an interesting case where they put legal action against Albemarle, which uses the Solar, Antofagasta Minerals, and BHP over how much they actually extracted from this aquifer. What Albemarle said that they don't want to be put in with the copper guys or tourism by saying, we only take 1%. Everything else we take is not potable and nobody can use it. It's got too much salt in it. But they're saying that the copper miners take about 40%. So that is a risk for production and a potential constraint. I mean, Chile's done an incredible job of finding power with the solar, the wind turbines, when Argentina cut off the natural gas. And they've done an excellent job of that. But to find water, much more difficult. And then if we get to Peru, again, left-leaning government, but people are more optimistic about Peru because this guy has no power. The Congress is totally against him. It's hard for him to pass anything. But it doesn't change the local issues that no matter what government you have, those issues stay. You can't sort of say, we got this new government, now our project's going to go ahead. No. So when I worked for Newmont, we had Conga. When I joined Newmont, we had to take Cerro Quilich, an open pit heap leach project near Yanacocha, offline because the local Cajamarqueños didn't want it. So then what happened? We got Conga, and Conga's a huge copper gold porphyry that we were advancing to reserves, and it actually got a permit from the federal government. But that didn't change the local impression of but they thought their concept was that was going to impact our water. And so then we had to take it off reserves, but this was after I left Newmont. But just right now, because the copper price is improving, Yanacocha is going downhill, Newmont is revisiting the idea of building it. But they, again, closed down Yanacocha. It's easy to do because there's just one road going up the hill. They close that road, nobody can get up. You got to helicopter people up and down. So they've done that just because Newmont's just thinking about restarting or revisiting the idea of actually building this project. That's how strong the opposition is to that one. And Freeport, formerly Phelps Dodge, they have El Abra. El Abra was a solvent extraction electrowinning project that now they want to get the sulfides, which involves a lot of capital, mill expansion. But they're not going to do anything either until the Peruvian government gets itself sorted out in terms of the royalties as well. The other problem in Peru, which has been a problem that's been growing for the last decade, is the infrastructure. Not enough roads, not enough ports to take all the copper they're producing. So it just takes one road to be cut off, and then suddenly the concentrates don't go through. It takes one person to get in front of the port facility, burn some tires, and suddenly you don't have the trucks going to the port. That's how hard, easy it is to stop that concentrate from going into the general market. So infrastructure is still an important thing, and that's before this government actually got into power. And so it's not only in South America that we have issues, but obviously in the States there's issues. And so here's one that near and dear to my heart because I lost money on this one. So Trilogy Metals, the upper cobalt mineral, probably Arctic, high-grade volcanogenic massive sulfide deposit, copper dominant, had great partner, South 32, has the local Native Corp, NANA, that's all on it, state governments onto it. And then there was this record of decision on this road. And the road was actually, the permit was applied for by the state, not even by the company. And they've, 5,000 pages of documents, 5 years of consultations and going back and forth, and then getting issued the permit on July 2020, which was a significant catalyst. And the problem here is just recently with the change of government and the fear of getting sued by the NGOs who went to a few villages that might have had 30 people in them that were about 25 miles south of the road, potentially concerned about the caribou migration. I'm not sure. But they revisited it and they said that they have to redo the permitting after 5 years of process, documents, and actually getting issued. That's not good. Okay. I can't swear here. But now that we've just had the midterm elections, the Democrats kept Senate, but the Congress has changed. So there is potential that we could get some sort of resurgence, especially since the Biden government is still pushing critical minerals. And they're supplying a lot of the funding. So the Department of Energy, I think it was helping, Talon Metals with $110 million. And now they're investing in Australian projects. They'll be investing in Canadian projects, trying to get this critical mineral supply chain going. And so where I was coming from, as Kai pointed out, I was coming from Africa. So I was in Zambia, again, with a focus on copper. And I spent a day at Kansanshi. So Kansanshi is owned by and operated by First Quantum. It started back in 2005 in the Central Copper Belt. It's not, in terms of a Central Copper Belt one deposit, it doesn't look anything like that. It's very different. But it's big. They're looking at increasing, almost doubling the throughput. So I think it was 22 to 25 million tons per year. Now they want to go to 55 by 2025. The pits will coalesce, and the pit will go down another 180 meters. The strip will get bigger, 3.8 to 4 to 1, but they have no problem with it. And why don't they have a problem with this major investment that they're making? Is because the government has changed in Zambia, and it's very pro-business, and a lot of people are in Zambia now. So, and then also Mark Bristow, I think, announced that they're extending the mine life of Lumwana. And these guys are going to take this project. This is going to go well beyond 2040. And they also spent $150 million on a nickel project called Enterprise, which, if it gets going, when it gets going, it'll be the biggest nickel producer in Africa. Okay, and they need a lot more power, 190 megawatts, 8.5 cents per kilowatt hour. So they're going to try and build solar, I think a wind turbine or a solar farm with the government there as well. Yeah, the mine employs 6,000 people, and they're looking to keep going for another 26 years. Okay, now future production. And this is what's not coming into 2025 and beyond. And so this is one of the most interesting graphics from the IEA study about critical minerals. So one side, the left, talks about where the critical minerals are coming from. Where are they being sourced? And then the other issue that people miss is where they're actually being processed, because manufacturing does not use the intermediate product. They use the refined product. And what you notice is that from production standpoint, you're okay. It's Chile, Peru, countries. I mean, they've got their issues, but, it's countries you can deal with. But on processing, if the U.S. is looking to cut out China and consider them an adversary, they're kind of screwed. Because over the last 2 decades, they've been pushing all the manufacturing capacity overseas. Limited amount Mexico could do, but infinite amount China could do. And China took everything. They wanted all the manufacturing capacity and did. And my theory is that's why we haven't seen inflation in about 20 years. It's all gone over there, and they manipulate it with their currency. Now it's going to come back because now we'll see, hopefully, those good paying jobs, but that's going to hit our bottom line. So, but this is a problem. You can't build this overnight. That took them 2 decades, and that's a command economy. Try doing that, changing the president and the Congress every 2 years. So this is the other incentive that'll drive a lot of where people invest. If the EV vehicle is made, if the EV is made to be sold in the States, is that they've come up with this EV tax credit, part of the, I forget what it's called, inflation reduction, whatever, that thing. So half of the incentive is based on where the mineral comes from. And that ratchets up from 40% to about 80%. And then the other part of it, where does the component come from? And that goes from whatever, 50% to 100% to 2029. And so this is limited to having those parts and minerals either in the States or a free trade agreement country, which narrows down the possibilities significantly. And the other imposition is ESG. Like, China doesn't have these impositions on where they operate and what they do, but the Western countries will. So that will constrain production as well, whether it be water, whether it be emissions, all that sort of stuff, and who invests in what. Where do you get your capital from? And so what you'll see, and you are seeing, is consultants doing this not only for the companies, but doing this for the BlackRocks and doing this for all the major investors to say, oh, which project do you want to be in? So when you would normally look at cash costs and I want to be in the first half of the cost curve, now you're talking about emissions. This is just greenhouse gas emissions and carbon footprint. You want to be to the left. And so, but again, most of the stuff that's on the right is all made in China, but they don't really care. That production will still happen. So scope 1 is the emissions that are generated at site, and most of that's diesel trucks and stuff like that. Scope 2 is the power required, and where's it coming from? Is it coming from hydro? Is it coming from coal? Is it coming from natural gas? Whatever, that's scope 2. And then with copper, unlike gold, because you produce a doré at site, you have freight, shipping the concentrate to wherever in Asia. Then you add the power used by the smelter. So if the smelter is actually using coal, these guys will find out and then add that to your ESG footprint. And so the other problem is grade. So, this is just Chile, but I think you can say it's probably for most countries. So the top is concentrate, sulfides, and the bottom is heap leaching, which is the SXEW, solvent extraction electrowinning. And the middle is the average. So what you can see is a decline, from the sulfides going from well over 1% back in 2005 to about 0.8. And then SXEW, which is lower cost because it just involves crushing and no milling and no flotation plant, has gone from about 0.7 to about 0.6. The issue with SXEW is geologically there'll only be less and less and less because nature can only make so much of it. And then you have to get into the sulfides, just like your El Abra, like your Cerro Verde. But if you look on the right, this is the important part of ESG footprint, the lower the grade, the bigger the footprint, because the more trucks you need to get the same production because the grade's lower. So you're moving more tons. And this is really another huge issue, is that if we don't know the project now, it's not coming in the next 15 years on average. So that's why I don't want to say I'm pessimistic, but I'm optimistic on the price because I'm pessimistic on the supply, if that makes sense. Okay, and so what makes me optimistic is the industry knows the problem, even if some other people don't. So we saw a lot of drama over two major M&A transactions, large diversifieds wanting more copper exposure, Rio Tinto, BHP. Rio Tinto bid for Turquoise Hill, initially rejected, and these guys never reject anything. But these are the independents that look at the transaction and recommend it to shareholders. They rejected it in line with a pair of hedge funds, but then they eventually accepted at a higher price. Then a new twist was the Quebec government said it wasn't fair to the other shareholders, and so Rio Tinto had to go back on the deal and go back to the original price, but now it's basically hanging. And what the whole idea is Rio wants more copper exposure. For them, there's no added technical risk from owning more of something you already operate. There's never been. Like when I worked for Newmont, we bought the rest of Boddington. It was easy. We already knew the project. We knew the technical risk. We just need to acquire it from Anglo. It's the same thing for these guys. But this would be, once they go underground, the fourth largest copper mine worldwide. And that's what Rio Tinto wants. And so from Oz Minerals, that was a bid that was put in earlier this year, and it was rejected. And that's a good telltale sign that things are being undervalued and people think copper price is going up, because their shareholders said, no, it's too cheap. The copper price is too low, and you're getting us at the bottom. So BHP waited, and now they've come up with a new price that's been accepted by the board. But in the end, what's nice about it is prior to BHP making that bid, that share price, it was still about a 50% premium. So this is a premium, 50% premium in this market on a very liquid intermediate copper producer that's based in Australia with operations all over the world. But interestingly, here's the point, is that BHP, one investment bank, I think it was JP Morgan, said that their exposure to copper would go from 25% to 40%. And that's the goal, to increase exposure to copper. And that's exactly what I want to do as well. But this doesn't change anything in terms of production. Consolidation doesn't change production. It's still the same whether Turquoise Hill owns it or Rio Tinto own it, or whether Oz Minerals produces it or BHP produces it. That's not a pound more of copper. So the underlying thematic is the same. But what it gives you a signal for is these people want more exposure because they can see the problem coming. And so on the smaller side of investment was, a Rio Tinto doing a $25 million strategic investment in Western Copper Gold. And this is a low-grade porphyry. Low-grade meaning less than 0.2% copper, 0.2 gold, and a heap leach at surface. So, but it's, Yukon is a great jurisdiction, but infrastructurally it's significantly challenged. And copper projects need a lot of power. There is no power. So that is something Rio Tinto is willing to take a risk on. When they came into it, I asked the CEO, do they think that there's something else there that they could drill? No, they're okay with the grade. What they want to do is permit, and what they want to understand is infrastructure. And the Yukon government's all for that, but the thing is their hands are tied because they don't have the kind of tax base to build the infrastructure. But it's just a sign as to where companies are going. They're willing to take these options right now, thinking that the market might be better later. Okay, I think we're good. Summary and conclusions is copper's down, as we all know, about 20% year to date, but in local currencies of major consumers, it's actually up. Near-term demand is volatile. China's zero COVID policy, risk of global recessions. Copper miners are basically increasing production, not decreasing, and that's what the problem we have right now with the lower prices, but they're doing it with lower margins. So the incentive to grow production right now is not very high. And if Chile increases royalties or taxes, less so. Social license to operate issues, less so. And so right now, the list of critical minerals does not include copper in the U.S., which is important. But that can change in a year or so once they find out what they actually need. Forecasts of global copper demand growth, really, it hits after 2025. But as I showed you, if we don't know these projects right now, they're not going to come in 2025. So again, a lot of risks to near-term production, but potentially even bigger risks and constraints on future production. And the M&A right now suggests that the industry is well aware of the issue, and they tend to precede any kind of market turnaround. So thank you very much.
Yeah, thank you very much, Joe. This was very interesting to have your view on the copper market. And we have time for questions, so please. Here.
Question about the fuel supply.
Yeah, fuel supply.
Yeah, so actually USA is now dumping a lot of depleted reserves on the market.
Yeah.
And they are going out.
Yeah. So the oil, that's dropping the oil price, you're saying? Yeah.
But what do you see that near-term about the oil prices starting to rise because they have to replace it?
Yeah. Well, yeah. I'm not an oil guy. I look at more the impacts on the miners with diesel. Yeah. But yeah, like what you're saying is absolutely going to drive up the cost applicable to sales for these producers, and that's not going to go away unless they can. I mean, some copper companies have, like Kansanshi, they've got, if they build that the solar wind power farm that they want to build, I think it's like 190 megawatts or something like that, but they want to electrify all their trucks so to reduce their exposure. But not everybody has that kind of option, and so that's what you want to look at as well, as people that can basically, lower their risk to energy, because these big copper projects require a lot of energy. And if you're exposed to diesel, natural gas, that's not only ESG footprint, but that's also a cost margin issue for these guys. But it will impact the price, because like price equals marginal cost, it will drive up the majority of copper production costs. I hope that helps.
This projected deficit of copper over time, is it based upon the pipe dream of where we think EV is going to go? So is that like not real?
Yeah, that's the risk. That's the risk for what I'm saying on the demand side is I don't think that's going to happen. The penetration won't be that much just because there won't be enough critical minerals, and I don't think it'll be. But saying that, there's not even enough copper to fit the most, a smaller scenario, because it doesn't exist right now, and people aren't investing. And that's the same for a lot of commodities. It's just nobody's investing, and so that's going to hit, and it's sort of like a bit of a twist that's going to impact demand because they won't be able to produce it. But the underlying is that what they can get, they'll pay for. So I would stake more on the supply risks than on the demand potential being more than people expect. I think it's probably going to be less, if that helps.
More questions? Okay, maybe from my side, one question. We have a little bit of time. We have here some copper exploration companies, and we have, for example, companies from Kazakhstan too, or who are active in Kazakhstan or jurisdictions where we don't have so much experience as people from Europe or North America. What do you think? You've been to Zambia, yeah, and I mean this is the future, isn't it? Especially for copper, nickel.
Yeah, well, I mean, in terms
especially
of,
just
yeah.
if you regard that we are cutting off Russia, yeah, I think they have 4% of the copper production worldwide. They have a lot of nickel, etc.
Yeah.
So, how do you see that? These
well,
developments?
Russian copper, just like Iraqi oil, is not going to disappear. It's just going to go to the Chinese and the Indians.
Okay.
That's where it's going right now. So don't think that that's gone off market. So The only thing is that the Western economies don't get exposure to it. So then they have to look for other places to get it. And if you're not exposed to it, you're fine. But, the Chinese are going to take all of that. So what's going to impact, like, jurisdictionally when you invest is, like, who's going to, like, when you look at junior mining, who's going to be the acquirer? And then say, well, how are they looking at it? Is it going to go to the west or is it going to go to the east?
Yeah, but you had a perfect example in your presentation.
Yeah.
The Kalmua mine is owned by Ivanhoe Mines,
Yeah.
but they're strategic investors from China.
Yep. And that's another issue is that now the Canadian government is trying to basically eliminate Chinese equity exposure to companies that produce critical minerals.
But could Canada say, no, China, you can't buy Ivanhoe Mines
That's what they're saying.
if the operation is in Congo?
That's what they're saying. And that's what's weird.
Yeah.
That's what's weird, is that they're trying to do that for companies that are actually operating outside of their jurisdiction. But they've done that before.
Yeah.
So that's another thing. And so if you're looking at M&A, if it's just China that could potentially take that project, let's say in a place that the U.S. doesn't deal with or the Western economies don't deal with, then your M&A may happen, but there will be no premium because the Chinese won't pay a premium. But if you can get it on the Western side, the chances of you being financed by the Department of Energy or the Department of Defense or somebody like that go up, even the Canadian government. So there's this palladium copper project in Northern Ontario. They need at about $1 billion Canadian, but 200 million US has been committed to by the Export Development Bank of Canada, which I had never heard of, but they mostly invest in projects not in Canada. They don't invest in projects in Canada, but now they are.
Yeah.
And so everything is sort of like very volatile right now. All I know is that, in terms of copper, the development timelines, the costs, all that just point to a higher copper price.
Okay.
All right.
Good.
Thank you very much.
Thank you. Thanks a lot, Joe.
Thank you. Sure.